afternoon, ladies and gentlemen, and welcome to Friday, April 8th, 2011, our open discussion for Friday, April 8th, I should say. Another week closer to the standard April expiration, and of course we did have the second week of April options technically close at 4 o'clock, even though the true expiration for those will be in about 5 or 6 hours. And of course we're also waiting to see what happens in the next 5, 6 to 8 hours or so, see if we still have a functioning government, for lack of a better term. In any case, that's not what we're here to talk about today. We're here to talk about options education and have your questions answered that you have specifically on options. Hey, John, I am having a good day today. It's a bit rainy here in the Mid-Atlantic and raining all day, but all in all, I've had a good day today. I hope you had a good day as well, John, and I brought your questions. And that goes for everyone else as well. Well, let's go ahead and just get started with some basic introductions and some processes and procedures for this afternoon. My name is Mike Chupka. I'll be your presenter this afternoon, as I usually am every Friday at 4:30 p.m. Eastern Time. I'm the Director of Education here at PowerOptions. As you know, PowerOptions is a patented suite of search and analysis tools designed for self-directed options investors. We support over 23 different strategies, patented search tools, research and analysis tools as well, and a powerful set of portfolio tools to help you track, manage, and calculate for you adjustments that you might make on your position. We actually just added a recent adjustment to one of the debit spread positions, something I'm kind of fond of. I refer to it as the pendulum adjustment, and if we have time we might show that as well. I've been the Director of Education here for several years. I've been with PowerOptions for 8 years. I handle a lot of the coaching sessions and education on the site. I always like to mention that because if you haven't taken advantage of that yet, if you're on a free trial or a subscription to PowerOptions, you want to make sure you take advantage of one of those free coaching sessions. It's essentially a 40 to 50-minute phone conversation, typically with myself. We'll walk you through the tools on the site, answer any questions that you have, even if those questions are about strategy, strategy management, and so forth. We've co-authored 2 books on investing with Ernie. As I mentioned, we support over 23 different strategies on the site. I am versed in all strategies. However, there are certain techniques I don't trade in my personal account. Things such as iron butterflies, short straddles, short strangles, and naked call positions. They don't match my personal risk-reward tolerance, so I do not trade those. But if you have any questions about those, please feel free to send them on over. All right, the process and procedures for this afternoon's presentation. Use the question pod over there on the GoToMeeting technology, GoToWebinar technology, to send me any questions that you have about PowerOptions, options trading, radioactive trading perhaps. Just send over any questions that you have. Ask as many questions as you want. We may not have time to answer all of the questions, but we will definitely try to make sure that we stay on a little bit extra if we have to include everyone so we get all the questions answered. And of course, questions can be about tools on PowerOptions, radioactive trading techniques, PowerOptions Applied, the advisory newsletter service, or just general option strategy, general market questions, and education. Now, I encourage you to don't be shy. Ask any questions as you want. The pressure is not on you. The pressure is on me. There's no such thing as a stupid question. There are only such things as stupid answers. So it's on me to give a good answer to any question that you have. This presentation is designed for you to have a platform to have your questions answered. So you want to make sure you take advantage of that. Be patient. There might be 1 or 2 questions ahead of yours, but as I mentioned, we will answer all questions, even if we have to stay online an extra 15 or 20 minutes. We usually schedule these sessions till about 5:30 p.m. Eastern Time, but if we have to stay till 5:45 or till 6 p.m., I have no problem doing that. And I want to encourage everyone to feel free to help us help others. For example, if I'm answering a question based on my market experience, but your market experience in a particular strategy or a particular scenario is a little bit different, send that over to me and I'll share that with the group as well. We want to hear your point of view. We want to hear some of your discussions, what works for you, what doesn't work for you. And most important, hey, it's another Friday, getting closer to the Easter break. Let's get some good education in before the weekend starts, and let's have some fun. That's really what it's about. But it's fun in a serious way. It's your money, and you're trading with your money. We're going to do everything we can to help you, to make sure you're protected, to make sure that we feel you're on the right path, for example. But we want to have a little bit of fun doing it, but we are taking it seriously, trust me. All right, so for today's discussion, normally we start off the presentation. I'll run a search to identify the new weekly options that have been released for the next weekly cycle. Well, we're not going to do that today simply because every optionable stock, ETF, and index has an option that expires next week. So next Friday at 4:30, we will run a weekly search to see if we have any new weekly options. Right now, the last count, we had 60 securities, both stocks, ETFs, and indexes that offered weekly options. I'm expecting that if there aren't any new ones next week, for the following week expiration, that the following week after the standard April expiration, there will be some new options. I'm going to hold a brief discussion, very brief, on editing and saving lists in the PowerOptions search, how you can save those lists, and then we'll get to your questions. And of course, we have no immediate questions. Then we'll go through presenter's choice, for example. All right. Now let me navigate back over to the site real quick. Let's go to PowerOptions and start the presentation here. And let's see. We have a couple questions coming in. That's fantastic. Thank you, everyone. Let me do the quick discussion on editing the lists first, and then we'll get back to that. Why I wanted to go through this discussion on the lists is earlier today I was in a discussion with a customer, and they were trying to update some of their stock lists, but they weren't noticing any direct changes. And I just wanted to make sure two things that everyone's aware of if you're editing your list. And what I'm referring to is when you're in the Smart Search in any strategy, we scroll down into the parameter field, I have several different lists that you can screen against, that you can select to screen through. IBD 50, CanSlim. You can't change these lists, but you might have created your own personal list. I have one here, example list, a large combined list, for example, another example list. Well, let me select this first example list from my recommended list menu. Let me just submit that. I want to see what kind of stocks and what kind of positions we have here. Good results. Okay, so we only have 2 Agilent positions. This is probably just a small sample list. And we have a fossil position as well. But let's say for whatever reason I wanted to remove fossil out of the list right now. All right, so I would just scroll down into the field. Now in the recommended list box, I'm going to click on Create/Modify Lists. This will take me to the field where I can combine created lists, or I can edit those lists. So we're looking at the example list here. I've got 10 symbols in this particular list, so I'm going to click on Edit. And this will give me a window where I can make various changes. And we saw that we had the 2 Agilent positions, Apple, we didn't have any cover calls that match that, and we're going to remove the fossil position. So I'm going to check to remove FOSL, and I want to click Save. Now that would have removed it. See, we have 9 symbols, but in order to effectively cause that change, have that change occur in my lists and on the page, I can't just close down this dialog box. I can't just click the X up in the upper right-hand corner. I have to click Close Window, and it's going to ask me to resend the information. And so when it did that, it just reloaded the search for us as well. And now notice fossil is no longer in our results. We were only screening against those 10 stocks. The 2 Agilent positions and fossil matched it. But I have to make sure that I click that close window box in the dialog again. Anytime you're making those changes, you want to make sure that you don't just close this new window that comes up. You want to click the close window box to effectively save the search and refresh the information so that all your data is saved correctly and it can refresh your search right away. All right? So as I promised, that was very quick. It was very harmless. I just wanted to make sure everyone was aware that you want to use that close this window menu. Okay. Okay, John's asking some very specific questions about managing what's called the RPM, the radioactive profit machine, as we're tracking it in the portfolio. Let me do something real quick. Let me go to Other Strategies, and let me go to the default values. There we go. Okay, so I want to just make sure I have the married put there. We're probably going to go to the portfolio. Yeah, let's do that. Let's go into the portfolio. Okay, here's John's question, and there's about 3 questions in one. Okay. Now, Mike says you've gone over this somewhat, but he's referring, John's of course referring to previous webinars, not today. Everyone was here, you didn't miss anything. Okay, we've gone over this somewhat, but could you give your views on the following? If you open a married put, a radioactive profit machine, my objective is I'm expecting the stock to move up 5 to 8% or to the put strike price the way we set up the positions within the first 30 to 60 days. But what if it doesn't? Okay, i.e. if it stagnates or it heads south. Since the position adjustments don't show up in the portfolio section if it isn't close to the put strike, that's one of the triggers that's available, one of the triggers that's shown. Oh, what just happened there? I'm sorry. The question just disappeared. Give me 1 second. Okay. Okay, so the stocks, well, the bullish ones, John, will show up if the stock's trading at that point. The two neutral ones we don't have directly programmed in. Income method number 7 can show up in some scenarios, and that's one of the neutral strategies you'd want to apply. Of course, income method number 6 can work in all three markets. So they will kind of show up. Okay, it doesn't have to be close to put strike. If the stock drops, you'll see opportunities for income method number 9, John. Some points, if the stock drops a little bit, you might see an opportunity for income method number 7. It just doesn't come up that often. But if the stock moves up 5%, that's the trigger for the bullish income methods, but the real trigger is if the stock's trading right at the strike price. That's the best time. Okay, but going on. John wants to know, do you just review the IMs in the blueprint as to what to do? Well, yeah, it also depends on my SIGA model also. Also, when you decide to close a losing position altogether. Well, it depends on the loss, and it depends on my personal view. Why did this question disappear for me? I want to get it in this broader view here. So just give me 1 second. All right. So one by one, if I'm tracking the married put and the stock has not moved up as I expected, it's stagnating, and I don't see an income method adjustment. I don't see income method number 7 or income method number 8 appear. I may try to manually see if 7 or 8 is a good idea. If the stock's stagnating after the first 30 days, it hasn't really moved, I may also look to manually do an income method number 6 on my RPM, and I'll use the profit and loss chart to evaluate an income method number 6 opportunity. So even if it's not shown, I might manually look for a 7 or 8 if it's stagnating, or a 6. Those are the 3 that you want to use in a neutral market. Now, closing a position altogether is really more of a, I don't want to say strategic, it is kind of strategic, but it's really more of a personal choice there, John. And what I mean by that is that what's discussed in the blueprint are Kurt's broad approaches to when he might look to close the position. There's a chapter in the blueprint called Exiting an RPM. And yes, if it's below the 50-day moving average, or drops below the 50-day moving average as after the first 3 weeks or the first 2 weeks, you might want to consider liquidating the position, or you might consider doing income method number 9, which would show up in the search filters or in the position analysis view if you feel the stock's going to be coming back up in price. If the stock hasn't moved for me in 30 days or 35, maybe 40 days, but I still have the expectation that it's probably going to be moving up soon, I may try to do an income method number 6. That way I can lower some of the risk but still have the unlimited upside profit potential. Income method number 6, of course, does include selling a call, but we're also adding a call so that we don't cap our upside gain. If, however, I feel that my sentiment has changed. When I open a RPM, when I open one of these positions, and technically you should do this when you open any position, even if you're just doing some standard collars or on the side you're doing some credit spreads, you should apply the essential, what you think is the SIGA model for the position, the conditions, expectations, your goals, and the actions. For example, when I'm opening an RPM, if the current conditions where I thought the market was a little bit turbulent, but my expectations were that it was going to be moving up over the next 30 to 60 days, for example, and my goals are to maybe achieve a 2 to 2.5% gain per every 30 or 45 days, I'd open the position with a stock chart that I feel best suits that for my needs, how I analyze a chart. Now, if in the first 10 or 15 days I'm watching the position, or even the first 20 days, it could be the whole 30 days, if my expectation on the stock has changed, if I still feel that the market is going to be moving up, but something about this stock changed, some news came out while I was in the position, or something came out that didn't really sit well with me, I'd consider at that point just liquidating the position. I don't want to try to over-manage the position I'm in, assuming that I have to make it a winner. I'm okay closing it. I might have opened the position initially with a max risk of maybe 6%, but after the first 30 days, I can probably close out of the position if the stock has been stagnating or dropped a little bit, maybe for only loss of 2 or 3%, I'm okay taking that. I'm okay taking that small loss because I don't want to just leave capital sitting in a position that I'm not comfortable with. Even if I'm wrong and as soon as I liquidate it, the stock moves up, that's okay because I wasn't really comfortable with that position anymore. I wasn't in the right psychological frame of mind to keep trading that position. I'll take that capital, that small 2, 3% loss, and I'll look for a new opportunity in the market that I am more comfortable with. So that's kind of more of a personal preference. What's discussed in the blueprint in that exiting chapter, those are just some philosophies that Kurt and Ernie apply, and I will apply that sometimes too. If I feel in the first 2 weeks the stock was trading above its 50-day moving average, that's one of the criteria I would look for when opening the position, but now suddenly it's below the 50-day moving average after a 14-day period, that might be a sign that the trend is turned. Again, my expectations in the stock might be different now, and I might be okay liquidating it. Just take a small loss, put my capital into something else. So yeah, I mean, John, that's basically what I have for that question. If you'd like to, if you feel that, I should say, if you want to ask another part of the question again, or if you want a deeper explanation on one of those other parts, let me know. But if the stock's stagnating, I'll consider an income method number 6 or maybe an income method number 7. Usually I'll build that manually. Income method number 8 won't show up in the position action screen or the position analysis view right now, but that will be programmed in the future. I personally don't like using income method number 8 because it adds to the risk, remember. And income method number 8 is a version of that condor on top of your Mary put position, so you will have to put up extra margin to cover the bull put side. So in that scenario, I don't always like to use income method number 8. In fact, I don't think I've ever used income method. Nope, I lied. I used it once. I used income method number 8B. I think it was one time in one of my radioactive profit machines back in one of my first 2 or 3 trades, I believe. It's not that it's not a good income method. It definitely has its value, income method number 8. But it's a little bit more complex. And that's not to say I don't understand complex option strategies. It's just something I didn't want to have to watch on a more regular basis. I feel with income method number 8, you have to watch it a little bit more closely as to how you would adjust either side of those spreads there on top of the RPM. All right. Okay. All right. John, looks like I answered your question there, so thanks. Let me know if you wanted any other specifics discussed there. I want to encourage everyone else, if you have any questions on power options, radioactive trading, using the power options tools, of course, for any strategy, go ahead and send those questions over. I don't have any planned material. I do have something I can show you that I think is pretty neat, but you know, send those over. Okay, is this Jack? Yes, it is. Hey, Jack, how's it going? Jack wanted to know, what part of the software do you not get with the $60 per month subscription? Okay. The 20-minute delayed subscription to Power Options is $59.95 per month. That's the $60 he's referring to. You get access to all of the tools that we have, every strategy, every tool in every strategy with the 60-minute, let's try this again, $60 a month subscription with 20-minute delayed quotes. Okay, nothing's hidden from you. The upgrade to the real-time service, it's $79.90 per month. You know, additional $19.95 more from the $59.95 subscription service. You still have access to the same tools. It's just with real-time quotes. Meaning, if we were in the if the market was open, and we were in that, let's say, covered call search. There we go. I could click the submit button every second, or literally just click the refresh button on my browser. Just keep clicking submit, and I would see these numbers change. It's not streaming real time, but every time I hit submit, I'm grabbing the numbers at that very instant. So, you know, the option premium might drop a little bit depending on how the stock moves. We might see the percent if assigned or downside protection changed. That's the difference between those two subscriptions. Okay, you still have access to all the tools in the 20-minute delayed service, Jack. You just don't have that real-time service, but all the same tools are included. Now, with the professional level of service at $99.99 per month, you have access, of course, to all of the tools with the real-time, but what you also have access to on the professional level of service is the back test. So you can run the Smart History Excel to back test one of your strategies, see what covered calls would have matched your criteria on any given date back in time, and then you could roll that forward and see how those results performed over the expiration period. You also have the historical search by symbol, so if I just wanted to see married put examples, covered call examples, or collar examples on Apple back on April 2011 or 2010, I could look that up as well. And of course, when you have the historical tools added, you also have the automatic historical chain. So right now, if I just looked up, Apple, for example, let's just stay with that for the time being. There we go. Here's our 5 straight call chain for Apple, our weekly options that expired today, and then the regular expiration 8 days away. But if I wanted to see where Apple was, it's currently at 335.06, but if I wanted to see where Apple was a year ago and what were the option premiums, let's just go back to April 2010 on the select date field and select April 8th. Okay, 335.06. Let me jot that down very quickly. All right, so Apple was at $239.95 as of a year ago, and the April expiration was 9 days away. So on 4/8/2010, April expiration was on the 17th, 9 days away, and we don't see any weekly options because, well, the weekly options on the standard stocks didn't start coming out until June and July of 2010. Okay, so that's what you get with the professional level of service. It's everything you would have had on the real-time jack, with access to the historical tools, and you're not missing anything on the 20-minute delayed other than the real-time quotes. The $59.95 subscription, monthly subscription, that gives you access to every tool except for the historical tools, and you don't have the real-time data. That's the only difference. Okay. Are there any other questions? Let me see. I want to check something very quickly. If there are no other questions, I wanted to just show something, and I apologize. I had it when I was testing it with the programmers in my personal account, not in the webinar account, and I just wanted to see something here. Yeah, I think it was the 29. Yeah, it was the 2931. 2931. Okay, and I think it was 320. I'm just doing some quick math in my head. I apologize, everyone. Okay, I'm sorry, 140. Need that to be 140, so $1.80. Yeah, $1.80 plus $1.40. Okay. All right, so let me scroll through here. What I'm going to do is I'm going to try to put in a quick spread. I'm going to create a new portfolio for this to make it clear. And hopefully I can get this to work with the prices I think I put into the other one. Is everyone familiar with a bull call debit spread or a bear put debit spread? A bull call debit spread has the same risk-reward profile as a bull put credit spread, and a bear put debit spread has the same risk-reward profile as a bear call credit spread. Okay, so before we do that, let me go into bull put. Let's add those just briefly. I apologize here. All right, let's go ahead and I'm going to, instead of those two, I'm going to put in a bull call debit very quickly. There we go. And bear put debit also. Okay, let's save that. So just in case for everyone, John, you said yes, you're familiar with those. I assume everyone else is pretty familiar with those also. Let's go to the bull call debit home just really quickly. In a bull call debit spread, I'm going to sell an at or out of the money call, and at the same time, I'm going to buy an in-the-money call, a call further below the call that I sold. This call is going to be more expensive. The call that I'm buying is going to be more expensive of the two, so I'm going to pay a debit to get into the position. The stock's going to be trading, I'm going to want the stock to be trading above the strike price of the short call at expiration, and then I'll close both options, get the difference in the strike prices, and that will lead to my profit. Okay. Now, back on March 25th, I could have considered doing a bull call debit spread on Valero. And let me put that into this pendulum portfolio I was looking at very briefly. Oh, I didn't save it. Okay, hold on one second here. I thought I had saved it, but I didn't. And what I'm just going to show everyone here is a new rollout opportunity that's available in the position actions menu on the portfolio for debit spreads. All right, fantastic. Let's go into profit and loss portfolio. Now, in 325, I believe Valero closed at around $29.80. So at the time, I might have entered a bull call debit spread by selling the 29 call for about $1.80 and buying, or selling the April, I should say, call for $1.80 and buying to open the lower call for $3.20. Selling the 29, I'm sorry, and buying the 27. Okay, so let's go ahead and do that. It's VLO. Or did I do 30? No, it's 29. Let's do that. The April 29 call and the 27 is the one I bought. Fantastic. Okay. So here I'm putting in bought the 27 call, sold the 29. We're going to keep it simple and just use one contract and no commissions for the time being. Now on 325, let's assume a price for the call at about 320, I believe it was. The stock was a little bit above, it was above 29, it's about 29.80. And let's see, 325. Apologies, there we go. And we could sell this call for about $1.40 on March 25th, the April call. Let's put in 0 commissions. Okay, so let me track that in the portfolio. Now, of course, we're in trouble. Let's take a look. Ignoring this for the time being, let's take a look at our profit and loss chart for the position. And we'll review that. All right, so this was our bull call debit spread. We sold the 29 call when the stock was about $29.80 and bought the 27 call. We paid a debit of $1.80. The prices aren't right. I apologize. It should have. Okay, this will still work though. It's a small profit of about 11% or $20. I think the actual, this is supposed to be reversed. Our cost was supposed to be $1.20. We were looking to make $80 on the position. All right. So what we're hoping to have happen is we want the stock to stay above our short call strike price at 29. So that way both options would be in the money. We would sell to close. We could exercise essentially our long call to buy stock at 27, deliver it at 29. So that would give us $2 back. That covers the original debit, and then we'd have our profit of, in this case, $20 or 11.1%. Let's close that down. Now, as you see, okay, I have a quick question here from John regarding the bull call debit spread. Real quick, let me just address this. What we just saw there, let me go back to that profit and loss chart. What we saw in the profit and loss chart is the maximum return on the position occurs at expiration when the stock is trading above the strike price. And of course, if the stock moved up as soon as we'd opened this position, it was already at $29.80 roughly when we opened the position. If the stock shot up to $33 or $34, we could probably liquidate this bull call debit spread early to get close to the maximum profit. The deeper these options go in the money, you know, as the stock continues to move up on this bull call debit spread, the sooner we could probably close it out and realize 80% of the profit. Now, John says that the max is the difference in strike prices minus the net debit. That's the max profit. Right. In our case, it's $20. We paid a debit of $180. Okay? But if it moves up, stock moves really fast, you could close it early for more than the maximum ROI. Is that correct? I've never seen that, John. I've never seen a debit spread have a higher profit than what you could make at expiration when you opened it. The difference in strike prices and all-time value is out of the position. The only way I think that, I don't even think it would happen where you could make more than the $20 here. That's the max profit you could make, assuming all time value is gone and we're right at expiration. If there was some strange, wild increase in implied volatility, where the long option that's deeper in the money increased in implied volatility more than the call that you sold, so this option, the 27 call, became very inflated and the 29 didn't, maybe you could sell to close this call and buy to close this one for a higher profit than the max profit you'd expected. But very rarely will you see one option shoot up with implied volatility and not the same option in the same series on the same underlying security. If you have an example of that, John, if you've seen it recently, let me know, because I've actually never seen a position of debit spread where you could close it early for more than the maximum expected profit without legging out of the position, of course. All right. Now, let's go back to our position. The stock is now trading between my strike prices. This means I'm losing value. If I liquidated the position right now, it would cost us 30 cents to buy to close the 29 call, and I'd only get $1.39, so we'd get $1 back, and we'd have a loss of $71 if we liquidated right now, or 39.4% of our total risk. The risk, of course, being the full $1.80 that we entered into the position. And if we held it to expiration, that time value would decay, so we'd only be losing $61. What are the common adjustments on a debit spread? They're not as easy to manage as a credit spread, of course, because in a credit spread, if the stock started to go against me, if this was a bull put credit spread and the stock went below 29, I might just buy to close the 29 short put, for example, leave the 27 open, so if the stock continued to go down, my long put will continue to gain. There are also other adjustments you could do. Let's take a look and see if we've got anything. I may have to go back and change the prices if I don't see the adjustments that I wanted to see, that I'm hoping to see, I should say, that were available earlier today. So we link to the position analysis view. This gives us a breakdown of our position. Here's our current loss of $71, and I was right. There are no rollout opportunities. This is probably because I have to change the pricing to what it was. The risk was, the debit was actually $1.20, not $1.80. So I'm going to do this the easy way and just increase this to $2. I'm going to increase the premium to $2. I know it's not accurate, but I wanted to use this for an example. So let me edit that position, and I'm going to increase the premium to $2. That was the debit was $1.20 when the position was open. I think it was actually $3.60 versus, no, I'm sorry, $3.20 versus, no, $3, yeah. Anyway, let's get that to $1.20 debit. Paying $3.20 for the long, sold the short for $2, debit of $3.20, maximum profit of 80 cents. Okay, so let me see now if I can identify, if we have the position analysis I wanted to see. And I might actually just log out and log into my own portfolio if I don't get what I want. There we go. Both of them. Fantastic. All right. So this is more accurate. Right now, current liquidation value is $11 loss. If I liquidated both options with the stock being below my short call, it'd be at a loss of $11. If I held it to expiration, all the time value would decay out. This is assuming the stock stays at its current price of roughly here, right at about the break even, about $28.19. That's the current, oh, sorry about that. That's the current stock price is $28.19. Okay? So we'd have a loss of $1 if the stock stayed right at that price at expiration. Now, we have some rollout opportunities. The first one, which is a common thought, is we have this bull call debit spread. The stock has dropped in price. Why don't we just liquidate this position for that loss of $11 and sell a lower bull call debit spread? That's deeper in the money. So we could sell the May 27 call, buy the May 25 call. It's a new net debit of $1.57, but we could make a return of 43 cents. Now the total net debit here, this new net debit, includes the loss we took on the original position. So it's still a reasonable return. We've got a 62.6% probability. This is rolling down to a new spread. Now let's simulate trade and see if we can get these two to show side by side. All right, so our April spread is shown in red. That's the original position. It's gone against us. We currently have our current loss, including commissions, of about 9% or so. I didn't include commissions. Oh, I see why. Yes, so our current return is our current liquidation value is a loss of 9.2%. If we rolled the put down, we lower our potential expected return, but we're still in the money. We have a higher probability, a 60% probability of this spread working at expiration. This shows us the new cost for the position, including the loss from the original spread. And of course, we saw that we had about a 62.6% probability the stock would remain above 27. Now this is one adjustment. It'll cost you about 4 commissions, especially if you leg out of the first spread and then you leg into the new spread. So maybe as much as 4 commissions. That's maybe not a big deal depending on how many contracts you have and who your broker is. But see, the problem with just rolling down a spread, it's not something I normally advocate doing in a lot of scenarios because, well, clearly I was wrong on my expectation of Valero. When I opened the position, I expected it to remain above $29 per share. I expected it to stay up here through April expiration or higher. Okay? Now, the stock has fallen. And I'm going to roll down to this, but if I'm assuming the stock's still going to continue down, couldn't I also lose on this new spread? Yes, I could, trying to catch the falling knife or stepping in the way of the train. All right, but this is one potential adjustment. It's not one I always advocate, especially with doing the credit spreads. If you just say, oh, well, my bear call credit spread was threatened, let me just move it up to a higher strike. Well, if the stock still keeps going, you're just going to have a loss on that position as well. And eventually you see here what's happening is as we have to take a loss on the first position, we're lowering our max return for the new spread. If we keep rolling, if the stock keeps going against us, eventually we'll guarantee ourselves a loss somewhere down here at the bottom. Okay. Now what's another idea? Well, how about this? Well, we had a position. The stock moved against us. We had a bull call debit spread. The stock dropped in price. It went against our expectations. Can I take a losing position and with one simple adjustment turn what was a bull call debit spread on a stock that's now falling into a bear call credit spread and still make a profit? Yes, we can. See, what this shows is, remember, we have the April 29. Oh, I apologize for this. I didn't catch that today. We just programmed this today, so those headers are wrong. There should be short call and short put. Short call and long call. I apologize. Short call and long call. We have the April 29 call already sold for our bull call debit spread. Notice how that's not changing. In all these scenarios, we're keeping the same call. We're not adjusting it. What we are doing is we're taking the long 27 strike call. We're going to sell to close it and open an April 30 call. We're going to do a pendulum move. We're going to take, so here's our original, let me just draw it on here sloppily. Here's our 27 call and the 29 call that we sold. And all we're going to do is just move a pendulum. I'm going to turn this position from a bull call debit spread that's losing right now if we liquidated into a bear call credit spread that has a potential profitable return. This is assuming that we think the stock's going to stay down in price. Okay, so let's get rid of the 5th grade drawings here up at the top for that brief explanation. Let's see how professionals view it. So let's assume I kept a 2-strike difference, sold to close the long 27 call, and bought to open the April, I'm sorry, we had the April 27 call. Sold to close the April 27 call, left the 29 call alone, and bought to open the April 31 call. What would that look like? All right. So, not as high as a return, of course, but what we've done now is as the stock's falling, here is our original position. Remember, this being threatened, we currently have that 9.2% loss. If we roll the position, all we've done with this pendulum adjustment is we left the short call open, and we took our long call and moved it. Oh, I clicked on the 30. That's why that return looks so low. Let me close that. I wanted to do the 31. I apologize, ladies and gentlemen. Let me close that window. Let me simulate the trade with the 2-strike difference in the 31 call. Keep it a 2-strike difference where we started with. I apologize. There we go. How about that? Still not as high of a return, but what has to happen now? In the next 8 days, as long as the stock remains below 29, we've taken a position that we would currently have a loss in if we liquidated the position to a potential gain as long as the stock stays below the strike price. We've went from the bull call spread. We took our original bull call spread here that's now losing and converted it into a bear call spread by changing just one strike. We took the 27 call, sold to close it, and made a pendulum over here and bought the 31. We just pivoted around the 29 call and went from bullish to bearish. Sometimes you'll see a better profit than this potential, but with a few days left to expiration, instead of liquidating and taking a loss, if you feel now that the stock's going to stay below $29 in the next 7 days, you could still have a profit of $14 here, or 7.5%. Turn a losing trade into a potential winning trade, essentially converting the debit to a credit. So that's just one of the new opportunities, new rollout opportunities that was programmed in for debit spreads, bear put debits and bull call debits. I'm just kind of fond of that one, so I wanted to show it to you all just in case that's something you're trading or that's something you research and analyze. Okay, so that's why we went through that. Plus, I didn't have any other questions come in while I was doing that. So once again, I'll just, and of course that menu that we saw that showed the rollout opportunities in the position analysis field, that's available in every strategy. So in any strategy when you link to position analysis, you'll see rollout opportunities. In the debit spreads, credit spreads, there's adjustments in the iron condors, the married puts of course as well, straddles and strangles. So you'll be able to have some of the heavy lifting done for you, the calculations and the mathematics done for you when you're evaluating your positions. All right. Okay, so that was just a brief review of something new that's on the site, something new that's in the analysis field. I know not all of you might be trading debit spreads, but just something that's there for you. And eventually that'll be there. It's actually there right now. It just hasn't been put up live. But a similar idea on the credit spreads of doing that is shown as well. But on a credit spread, there are actually some other ways that are better able to manage the position as opposed to using that pendulum shift there to turn it from a debit to a credit just by rotating around the short option. All right. I don't see any questions in the queue, ladies and gentlemen, so I'll prompt you once again if you have any questions on any of the PowerOptions tools, any of the general options strategies, anything on radioactive trading, anything about the portfolio features we just reviewed, even if it's not related to that new technique, that new analysis view, even if it's just related to general portfolio questions, send them over. Go ahead and send them over. I'm going to be honest with some of you. It's something that has been confusing us for the past few days. It's not our faults, but we are working on it. Many of you are familiar that there are certain stocks now that have a preferred stock listing, for example, that will come with a .PR. I can't think of any at the top of my head. Let's look them up. Go ahead and then go into the symbol lookup field here. Sometimes, and if you want to find any stock, you just want to click on that lookup menu. And I'm going to look for anything that contains .PR. I know there's some basic ones I should know off the top of my head. Didn't even show up. Thinking, oh, maybe they're not, the preferred ones aren't optionable. Let's see here. Oh, some of them are just .P. Valse, PRA. Some of them will be just a .P. That's true. There's one. The preferred shares. I want to say it wasn't Bank of America, for example, but it was something else that had a preferred stock. So one of the big popular companies that was a preferred stock. Anyway, now this is interesting because PRPM looks like it's showing up correctly. What I'm getting at is that, oh, that's because it doesn't have options. All right. In the past couple of days, what the our data provider did, our upstreaming data provider, is they were asked to make sure that they're showing the .PR, the preferred stock, correctly with the .PR notation. They made a change to do that correctly, but unfortunately it grabbed every stock that had PR in the symbol and turned it into something with a .PR. So for example, many of you are familiar with Juniper, JNPR. Unfortunately, we realized this morning it was in the system yesterday, but unfortunately today it was out of the system again, and because the symbol that we're receiving is JN.PR, which isn't recognized anywhere. So we apologize for that inconvenience. That's going to be taken care of this evening, and it'll probably be up this weekend or at least Monday at the latest. So I just wanted to, if you guys are looking for a stock, WPRT is another common stock that was asked about this week, that was asked about today, I'm sorry, that also disappeared from the results because it was being read, it was being sent to us as W.PR.T, and it wasn't linking correctly to the options that were for that. So we're going to get that taken care of and have it available. John wants to know, could you go over the parameters of a CC? I'm assuming that means a covered call search, please. Okay. Well, there's about 25 to 30 different option criteria and 25 to 30 different stock criteria. Now, rather than go through each one individually, John, what I'm going to do is just think, for example, if I knew I wanted to trade a covered call, if I was going to enter into a covered call position, which I don't trade anymore, everyone knows that. I don't trade just covered calls anymore. I will do standard collars where I'm essentially doing an at or out of the money covered call trade, looking for the same criteria I would look for in a covered call. but I'm also buying a same month out of the money put. So I'm not risking more than 5 to 6% on my position, but still looking to make a 2 or 2.5% return. Got burned too many times using stop losses on covered calls, suffering 15 to 20% losses, so I don't do standard covered calls anymore. Okay, but let's say I wanted to do a covered call. And knowing what I know about options is that the highest time premium, as an investor, when I'm trading options, when I'm selling premium, the highest premium, or the highest time value, I apologize, on any option in the chain at any given time is the option that's right at the money, the one that's closest to the stock price. I don't really gain intrinsic value. If I sell an in-the-money call, I might still be able to make a decent return and I have a strong downside protection, but my profit's only the time value. I'm not profiting on the intrinsic value. I'm only profiting on the time value. And the out-of-the-money option, of course, is all time value, but it gets lower. The time value gets lower, of course, as you go further out of the money. Well, the reason why I bring that up is because I'm going to focus on maybe selling an at or slightly, just at, slightly out, or slightly in the money covered calls. I'm going to look for stocks that I feel are trending, or look for stocks that are trending upwards, maybe have some strong fundamentals and some technicals, and I'm going to want to make sure that, it's good stock volume as well, and I'm going to have some good option volume too. So just those basic criteria. What I'm going to do, John, is let's scroll down to the bottom and hit clear these settings. Now, the parameter setup that you see is the same in every strategy. Essentially, there'll be some different criteria depending on which strategy you're searching for. But over on the left, I can tell the system how I want to sort my results table. Do I want to sort it by the highest percentage if assigned, the highest downside protection, maybe the highest probability of success? Okay, so we'll set that up. Well, there's only 7 days left to standard April expiration, so I'm going to do May instead. We're going to leave that in May. Now, I know I don't want to go too far in the money and I don't want to go too far out of the money. So what I'm going to do is limit my range in the money and out of the money. Normally I do percentage, but for this example I'm just going to do number of strikes. I'm not going to allow the covered call results to be more than 2 strikes in the money. These are the steps on the ladder. So if I have a stock trading at 50, let's say I have a stock trading at 52. 1 strike in the money would be the 50 call. 2 strikes in the money would be the 47.5 or the 45, depending if it's on a 2.5 difference or a 5-point difference. And I'm also not going to allow the position to go more than 2% out of the money. All right, now I didn't put 0 in either of these 2 boxes. The first box is why. If I told the system to show me the out of the money option 0 to 2, that wouldn't allow it to go up to 2 strikes in the money. It would overwrite what I'm trying to do here. But by leaving these 2 blank, the first box is blank, is essentially looking up to 2 strikes in the money, up to 2 strikes out of the money. And this is the same process you'd use on credit spreads, for example, or debit spreads. One thing I always like to look for, I don't want any surprises, so for the earnings date field, I'm going to specifically look for covered call positions that do not have an earnings between now and expiration. So I'm going to check that box for not between now and expiration. Well, I got my monthly goals, I've got my expectations and my risk aversion. So we'll start there. The percent return difference field, this is just comparing the downside protection to the percent if assigned. I don't normally use the percent return difference, but if you go deep out of the money, if you look at covered calls that are deep out of the money, you have a very high potential percentage return if assigned. But that's based on the stock going above that strike price and you're gaining the intrinsic value. You're probably only selling an option for 10 or 15 cents. So your downside protection would be really low, but your potential percent if assigned would be really high. So you'd have a very high percent return difference. Reverse, if I go too deep in the money, I can have a 20 or 30% downside protection, but the potential percent return if assigned of only 0.1%. Does that match your monthly goals? Probably not. All right. So the percent return difference can be used so you're not going too deep on one side or too deep on the other. If you keep the percent return difference, say less than 20 or less than 15, but I've already done that by restricting the number of strikes. All right, my downside protection, simply defined as the option bid price divided by the stock price. I apologize for this. The way that my dual screen is set up, and I can't click and drag them, but when I hover over any of these parameters, you'll get a pop-up definition. So if you're not sure what a filter means, just hover over it and you'll get a pop-up definition. But I apologize. My system is set up so it's opening on my other screen, and I can't click and drag, because as soon as I move off it, I can't click and drag it over, and we've tried to set it up so the pop-up window will come up on this screen, but it doesn't. I'm sorry for that. But it is there, and if you have pop-up blockers on, it would tell you, you might want to turn off pop-up blockers, and if you click on the link, it'll take you directly to the glossary. All right. Downside protection, my option bid divided by the stock price in a covered call. Shows me exactly how far the stock can drop before I'm technically losing money on the position. I'm going to be greedy and want at least a 5% downside protection. This, by the way, will probably filter out some of the more out-of-the-money options because I won't be collecting at least 5% of the price. Now, my percent if unchanged, if the stock stays at the same price, well, I typically want that to be greater than 0 if possible. That's a personal thing. And my percent if assigned, what I'm going to be looking for, of course, what's the max return I can make if the stock's trading above my strike price. I know many of you may have come from, or you may have attended webinars or seminars that you paid a couple $1,000s for that tell you can make 3 to 6% on covered calls consistently, and that'll end up being a 100% return year by year as you continue to just reinvest the profit that you make. Realistically for me, percent if assigned expectation on covered call, maybe greater than 3%, maybe greater than 2.5%. I never expect to make more than 3.5% on a covered call trade, on a reasonable covered call trade for me. All right, so my percent if assigned, I'm looking for anything that has a 2.5% if assigned or higher. At the same time, the 5% downside protection. Volume today, general rule of thumb in any strategy that Ernie and I teach, if you know on average you're going to be opening maybe 500 shares and 5 call contracts, okay, then on average that's the block size you trade with a covered call. Or if you're doing debit spreads, you know you trade 10 calls and 10 puts. Jack says my biggest losses have been covered calls. Jack, that's how I started too. When I first started trading 8 years ago, I learned covered calls. Within about, I think it was 5.5 or 6 months of trading covered calls, I gravitated over to standard collars. That really helped me out a lot. And yes, I take some losses on the standard collars, but losses that would have been 12, 15, or 20% with the covered call, even if I was rolling it, were limited to only 5 or 6% on the standard collar. But yeah, I'm sorry to hear that, Jack. Those were my biggest losses too. Actually, no, the biggest loss I ever had was trying to manage an awkward long strangle I put myself in about 4 years ago. That was just a bad idea, going long 2 options and then trying to adjust it and, trying to average down. It was ugly. Anyway, back to the volume and the open interest, the liquidity. What Ernie and I usually recommend is that in any strategy, you want to look for maybe an option volume that's at least 5 times the number of contracts you would regularly trade and an open interest that's 10 times. That's bare minimum. Okay, that's the low end. I know a lot of you might only trade covered calls if your option volume is around 500 or 1,000 contracts and the open interest is maybe closer to 5,000 or 10,000. Nothing wrong with looking for more liquidity. But if you're stuck and you don't know what to do, if I'm expecting to trade on average 500 shares and 5 contracts, I'll look for an option volume today that's 5 times the number of contracts I plan on trade, so we'll look for 25 and an open interest of 50. Very base rule. Now, I typically don't screen for an option bid price, a minimum option bid price, because I like to base that on the return. But if I don't limit the stock price in a couple minutes, for example, I may find stocks that are only trading around the $3 range or $4 range. So a 2.5% return on a $3 stock, well, we're talking about 15, 20 cents. If I know that that's really not going to, my commissions are really going to eat into that, and I have a minimum requirement for option bid, let's say 50 cents, well, we'll put that in as well. Okay, now the Black-Scholes ratios. Black-Scholes ratio, 50-day and SIV. The Black-Scholes number, of course, is the theoretical price of the option, where the option should be priced. This is based on 5 different factors: the underlying stock price, the strike price of the option, whether it's in or out of the money, of course, the days remaining to expiration, the current free market interest rates, and the stock's volatility. Now, volatility can be measured in many ways: 20-day, 50-day, 100-day, 250. What this Black-Scholes ratio is showing us is the actual trading price of the option. Where's the option trading at right now, divided by the theoretical worth. And the 50-day means it's used the 50-day stock volatility to calculate the Black-Scholes number for the ratio. Now, the SIV, this stands for the Stocks Implied Volatility Index. So rather than using the movement of the stock as a volatility measure, the SIV calculation looks at all the implied volatilities of the near-month and 2-month out options, all the in-the-money, out-of-the-money calls and puts, takes the implied volatility and takes the average. So instead of using the stocks movement as a gauge of where the option should be priced, it's looking at all the options around it, essentially all the implied volatilities around it, to see if the option is overvalued or undervalued. If you wanted to look for overvalued options, you'd look for a Black-Scholes ratio of greater than 1. So for example, if a call had a Black-Scholes ratio of 1.10, that would tell me it's 10% overvalued. And of course, if it's at 0.90, that tells me it's 10% undervalued. Many of you might be familiar with use implied volatility more in the sense that maybe you like to use the IV over HV, the implied volatility of your option divided by the historical volatility, or IV over the SIV, again, the average implied volatilities, to look for an overvalued or undervalued option. In other words, same values. If the IV over HV is greater than 1, that tells you that the implied volatility of the option is higher than the historical volatility of the stock. And again, IV over SIV, same thing. And you can screen specifically for implied volatility or percent implied volatility range. The percent implied volatility range shows you where is the option's implied volatility now compared to where it has been over the life of the option. Now, I'm going to be honest with everyone. I don't typically use these filters, Black-Scholes ratio, 50-day SIV. I'm assuming doing a standard collar when I'm looking to sell calls and buy a put. I don't use the implied volatility. I might use the percent implied volatility range, but I don't use the IV, HV, IV, SIV. To me, I understand why you would do that. You want to get more bang for the buck. You want to look for overvalued options. But I tell you what, after I put in my stock criteria, if I find a position that has a 3% potential return if assigned on what I look to analyze as a good quality stock, I have my downside protection of at least 5%. If it matches my return goals, and I'm comfortable with the direction of the stock and the fundamental and technical criteria of the stock after I do my due diligence, am I going to be concerned that it's overvalued or undervalued? No, because it's a good quality stock that matches what I feel the stock's going to go. It matches the direction I want the stock to be in, and it has the return I'm looking for. I don't care if the market considers it undervalued or overvalued. It matches what I'm looking for. So I very rarely use the Black-Scholes ratios or the IV over HV ratios as well. Okay. Now, if you wanted to limit it by bid-ask spread, you could do that also. If you only wanted to look for positions that had a limited bid-ask spread. Now, why might I use? I did say that, and I'm also not using delta. I apologize. The reason I'm not screening for delta is because I've kind of already taken care of that with this restriction of range in or out of the money. I know that since I've already limited the search to not go more than 2 strikes in the money or 2 strikes out of the money, I'm only going to have deltas probably between 0.4 and maybe 0.8. 0.8 at the most. Probably going to be more like 0.45 to 0.75. That's going to be the widest range of my delta. And if I wanted to just look for deltas that would be between, let's say, 0.45 and 0.55, in other words, I just want to look at the money options, just could have restricted the show in the money, show out of the money more. A lot of these filters go hand in hand with one another. Okay. What couldn't I do? Right now, I could not do this screen where I'm only looking for strikes that are no more than 2 strikes in the money and no more than 2 strikes out of the money, and look for deltas of 0.90 or greater, because this would only show me the deep in the money options on any stock, but I've already filtered those out by my requirements. And also probably filter that out by the percentage assigned as well. All right. Now over on the right-hand side, of course, is our stock filters, fundamentals and technicals, and you'll see this on every strategy. Okay. So I might just look for stocks between $5 and $55 per share. That just matches my criteria. Oh, very quickly, Margaret wanted to know, back to the discussion, with a standard collar, do you normally choose a covered call strike above the put strike price? Absolutely. When I do my standard collars, that profit and loss chart looks very similar to what we saw with the bull call debit spread. Real quick, standard collar setup for me, let's say we have a stock trading at about 49. I'm going to sell the May 50 call and potentially look to buy the May 47.5 or May 45 put, the out-of-the-money put. In a standard collar, the put is always below the call strike. when you're doing the same month to expiration. Otherwise, you could do it the other way. If you had a call strike below the put strike, you know what you'd have then, Margaret? You would have a bearish position. You'd want the stock to drop and be trading below the short call strike price in order to make any profit. When I do the standard collars, I set it up where the call strike is above the put strike, same expiration month, and the call that I'm selling is usually right at the money, if possible. Slightly in the money, slightly out of the money, but typically right at the money. All right, very quickly, let's just run this search real quick, see how much further we want to filter this down, and then we're going to cut out of this. I'm just going to review this quickly. All right, so we have 120 results, and I can tell you right away there's some things I would not trade here that have too high of a volatility. Bear 3 times ETFs, for example. Just bear 3 times, and probably the ETN, the VIX, the VXX I would not trade. I may use implied volatility to filter out options that have too high of an implied volatility or stocks that have too high of a volatility, for example, biotechs. But normally, the other criteria that I'd look for in a covered call, which is the same kind of criteria I'd look for in a naked put position or even a standard collar, are going to filter out those high-flying, highly volatile companies. I want companies that reflect good growth, so I might use a filter earnings per share growth of at least 5%. I might look for a price-to-earnings ratio, 0 to 50, 0 to 70. And this isn't a recommendation or suggestions. These are some broad ideas. And a lot of the default searches in the covered call menu, naked put menu, and covered call will already have these base fundamental filters put in. If you use broker recommendation, you can look at that as well. It's based on the ZAC scale, where 1 is your strong buy, 2 is your buy, 3 is your hold, 4 is a sell, and 5 is a strong sell. So if I'm looking for stocks that are recommended a strong buy, a buy, or between a buy and a hold, you might look for an average broker recommendation of, let's say, less than 2.8. If I wanted to restrict the historical volatility, well, we could do that. Maybe I don't want anything that has a stock volatility of, let's say, greater than 0.85, 85%. If you're more conservative, you probably want to lower that. You wouldn't want to see anything with maybe a historical volatility of greater than 0.6 or greater than 0.5. All right. If you wanted to screen for a dividend-paying stock, we could just put in a % dividend yield. I want to see an annual 1% dividend, 2% dividend, for example. Market cap, average stock volume. This is actually measured in thousands. So if I only wanted to see stocks that have traded at least 750,000 shares per day, just go ahead and plug that in. And, you know, just common things. I want stocks with good volume and options with good volume. Not too much volatility. It's a double-edged sword. I also don't want anything with too low of an implied volatility. But I don't want to see the historical volatility too high. I don't want any real high flyers that could go against me. Good broker recommendation, PE ratio, and earnings per share growth. And, well, let's just increase it 5 to 75. Why not? This is just based on my personal account size. I'm probably not buying a lot of $100 stocks, or I'm not buying an Apple covered call, for example. All right. Now let's go ahead and submit those and see how many we've cut our list down to. Hopefully I haven't handicapped myself. Nope, good. Now you see, I do still have some volatile positions. Silver Wheaton is in there. It's been a good stock recently, but I know there's some risk there. It tends to move a lot. The Vision Tech, I'd have to look at the stock chart, see what's going on there. These are some common, Citrix, Big Lots, for example, Sun Power. There's SanDisk, some common names in here, okay? These aren't exactly, this isn't exactly the water cooler search. What I mean by water cooler search is sometimes I'll use criteria that are a little bit more restrictive. Maybe average stock volume greater than 1,000, earnings per share growth greater than 7, PE ratio 0 to 50, and a broker recommendation of less than 2.4. I'll typically receive what I like to call the water cooler stocks. You might see IBM in there depending on what return I'm looking for. Apple, stocks that you'd hear about discussed commonly, common household stocks, for example, and not household product stocks, but just ones that are discussed around the household. Now, I've filtered this down a little bit more. We have been in a turbulent market the past couple days, but if I want to follow the trend, let's say we only want to look for stocks who are currently trading above their 50-day moving average. So let's take a look at that as well, see what we've got. All right. So we narrowed it down to 24 results. Ford's in there, Ford Motor Company, Pier 1 Imports, common names, Talbots. Okay, that was on the second page. We just didn't see them until we filtered out. So this is a pretty good, manageable list. Now, as I mentioned, I'm not going to just jump on the first position that matched this criteria. What I do is use that more information button. The very first thing I'm going to do is look at the stock chart, make sure I'm comfortable with the performance of this stock, that I feel it's a good covered call. take a look at the profit and loss chart. And as you know, John, the first thing I would do is, let's say I did run this covered call search. I see the silver wheat in here, 46.91, May 48 call, about a 6% downside protection, an 8.6% if assigned. Yeah, but since I'm not going to do this position, what's the first thing I might do? Well, sell this trade. Maybe it looks okay. Let me go to the profit and loss chart. Why? Well, I've got a stock at 46.91, analyzing selling the 48 call. Decent return of 8.6% if the stock continues up above my strike, but I'm not taking this risk. You know that. So let me scroll up to the top, and just real quick, got a May 48 call. What if I combine that with, for 272, what if we combine that with, let's say, May 43 put? All right, so I'm going to click that on the view options field. It's going to tell me that's been added to the profit and loss. Got my 100 shares of stock, one put, buy one, sold one call, excuse me, buy one put, turn this into a standard collar. My return is cut in half, but I'm only risking 6%. That's not a bad trade-off either. If I'm right, I make 4.8%. Worst case scenario, if it's wrong, I lose 6%. It's really hard to get a 1-to-1 ratio with a collar, of course, because the market's priced against that. But that's not too bad. Potential to make 4.8% while only risking 6.1%. Am I still comfortable with 4.8% return? Yeah. Remember, my requirement was 2.5%. So this, with added protection, still matches. So after I looked at the stock chart, looked at the company information, did my research and analysis, I decided I like this position. Want to play around and see what would happen if I turn it into a standard collar for more protection. Okay? All right. What else, John? I reviewed that. Went through just kind of what I would look for. And again, that's not a recommendation or suggestion. A lot of you are going to have different fields of what you want to see for downside protection. A lot of covered calls traders will prefer to go deeper in the money to have the higher probability assigned. So you could just set the in the money range to be greater than 5% in the money, for example, or use the percent probability. And again, these are very similar criteria that you'd see in any search. If I was in the collar search, I'd still have, instead of downside protection, we'd have percentage max risk. I'd have percent return if unchanged to filter by and annualized, percent return if assigned, the max return, and I can set the volume for the call or for the put. I can set the expiration time frame for the call or the put or have them equal, which in a standard collar, that's what it means, that the expirations are the same. And I'd still look for only those positions that do not have an earnings between now and expiration when doing a standard collar. All right, so let's see here. All right, John, you're welcome. When you do a collar, do you buy the stock and put at the same time and also the CC, or you leg into it like an RPM? No, a standard collar for me is just like a static position. It's just like a spread. I enter everything at once. When I do a standard collar to help augment monthly returns, John, I do the same thing we just did. I'd run a search based on my criteria of what I'm looking for on that standard collar, and when I see it that right now between the stock price, the strike price of the call, and I'm sorry, the stock price, the strike price of the call, the bid, the ask price of the put, and the put strike price, if that has the risk I want of less than 7%, the return I want of less 2.5%, I'm going to put everything on right there. I'm not going to try to leg into it. I'm buying a May put and selling a May call right away. So I just enter it all at once. Richard, I was afraid that this might confuse you. Richard, here's my, John is very familiar with me. He comes to a lot of webinars, and I greatly appreciate everything he's doing. I will use that standard collar format we just looked at to simply augment monthly return. I trade other positions other than radioactive. Radioactive trading is not the only thing I do. On any given day, radioactive trading RPM positions represent 60 to 65%, well, I'll say between 50 to 65% of my total investing capital. About another 20% of my investing capital, I'm doing those standard collars, hit or miss trades, looking to make a monthly return. And, sort of the ideas are discussed in the Protective Options Strategies book that Ernie and I wrote together. And at other times, I might have on 2 or 3 or maybe 1 or 2 different bear call spreads or bull put spreads on some of the ETFs, depending on my market direction. Not only trading radioactively. So when I do a standard collar, Richard, yes, I'm expecting that in the next 30 days, the stock's going to be trading at or above my short call strike price. I'm looking to get assigned. But if I'm wrong and the stock completely runs away, I know I'm not risking more than that 5 or 6%, so I'll just close the position for the small loss. Probably not even manage it, probably not even adjust it. I'm just looking for a 30 to 45 day trade to maybe increase my my monthly profit. That's what I'm looking to do. It's not that I'm unhappy with radioactive trading, it's just I've been doing standard collars for 6 years, and I'm very fond of just doing the standard collar positions. So I'm not setting it up as an RPM. I'm just looking for a position that I probably wouldn't want to hold for more than 30 or 45 days, and I'm looking to make 2.5% return. In general, let me go back to our basic strategy configuration. And Richard, I'm not trying, I apologize that came across as condescending, but I'm always very open in all the webinars I host, even with Kurt, that I trade radioactively. I trade the RPM positions and have been trading it for 3 years, and I've had a lot of great success with that technique. But there are other positions I also trade. I still do standard collars, and I will continue to do so. I'll still occasionally do a credit spread or a debit spread on an ETF based on my market movement or my expectation of where the market's going to be in the next 20 or 30 days. Of course, I'm still using that in my radioactive trading techniques also, and I'm looking to evaluate income methods. If I currently have a couple bear call credit spreads open, let's say on SPY, for example, or IWM, my expectation is the market's bearish, I'm probably looking to apply bearish income methods on the RPMs I currently have open, those radioactive profit machines, Richard. Oh, John, you've got to take off. Well, thanks for joining us, John. Thanks for your participation. Have a great weekend, and we'll see you next week as well. So, John, take care, and we'll see you soon. All right, what I wanted to do here is just quickly add the standard collar and just put that back into our main menu there. All right, so run the search for the collar, of course. There we go. All right. Now, ironically, we still, there you go. Well, this one's a little bit different setup. It's not as profitable since I was looking at a different out of the money, but look at the first result in the standard collar search. Silver Wheaton, what we just saw in that covered call screen we ran, selling the May 48 call, but this time buying the May 45 call for 236. I think that's too close to the, that put is too close to the current stock price. It's too close at the money. It's really taking down the net premium. The max risk is really low, and the percent if assigned is really high. It still matches my goals there. I mean, this is about as close as a 1-to-1 risk-reward ratio as you might see in one of these standard collars. But I still think that put is too close to the strike price. I'd like to take on a little bit risk to have a potential higher return, as we saw with that synthetic one we built with the 44-45. But yeah, this general screen here is the initial value set standard collars. This is the default search when you go into the collar menu. And it's essentially looking for those positions I was talking about, Richard. You know, Cleveland Cliffs here at 98.70, selling the at the money 100 call, buying the 92.5 put. I'm not looking to bulletproof it. I'm looking, my expectation would be that this stock would be trading above 100 in the next 43 days, looking to make a 3.1% return if assigned, but not risking more than 4.6%. Is the radioactive trading technique superior to standard collar trading, which I still do? Got to be honest with you, Richard, yes it is. I fully believe that it is, because my gain is capped here in the standard collar. I have a very short-term protection, but I'm just trading these couple positions, maybe 4 or 5 standard collars a month, just to augment return, premium generation without risking too much. And you see the problem. Right away you can see the problem with standard collars. This is as close, as I mentioned, this first one is as close to a 1-to-1 ratio risk-reward that you might find. But, you know, these ones here, where was that Cleveland Cliffs one? I'm sorry, I just lost it. Oh, Schnitzer Steel is on there as well. How about that? All right, so here I'm looking to make a 3.1% return if the stock's above 100 at May expiration, and I'm risking 4.6%. With these standard setups on standard collars, Richard, I have to be sure that I'm right more often than wrong to make money. At least I'm not risking as much as I possibly could if I was in a covered call, even a covered call with a stop loss, or if I was in a naked put, or even a naked put with a stop loss. Okay? I've guaranteed myself that I can't lose more than 4, 5, or 6%. But I'm not going to have a 1-to-1 risk-reward ratio. I have to make sure normally on my standard collars that over time I still have to be right about 67, 70% of the time in order to overall make a profit. So it's not as superior as radioactive trading. Radioactive trading technique puts a lot of this into our favor and is a superior strategy to standard collars. But I occasionally just like to do this to get immediate income and have immediate income on the positions. Talk about potash. Well, I don't know what you want me to talk about, Rich. I do not give any stock recommendations or suggestions. I haven't been tracking potash at all. It's within the range that I might buy. Standard position here, potential return of 4% and a risk of 4.6%. Close to 1-to-1. Well, it's a little bit off. This one here, but there might be another potash position that I don't see. Yeah, I mean it's close to 1-to-1. I'm looking at a 4% risk to a 4.6% risk, Richard, to a 4.4% return. Do I have anything closer down at the bottom? No, down at the bottom we start getting more into the 5% risks. And as we go to the next pages, we'd have more 6%, 7% risks as well. But yeah, that one's pretty close. The one underneath of that, Newmont Mining, is 4.1 to 4.6. It's close to 1-to-1. Again, that Silver Wheaton one is by far the closest we'll probably find on this page. There might be some that have a return that are higher, but the risk would be, we might see a risk that's about 4.5%. I'm sorry, a risk that's a percent return that's around 4.5%, but the risk might be closer to 7%. Yeah, so that is pretty close. No, Richard, you're absolutely right. Pretty close to 1-to-1. Stocks at 58.06. The May 60 calls for 204. The May 55 puts for 165. So your net premium again is kind of low. It's only 39 cents. That's a positive premium you're collecting against the stock. But if you're assigned again, we'd make the 4% return, or the total maximum profit would be that 39 cents plus the appreciation of $1.94. And we're not risking more than 4.6% or $2.67 of our total investment. And of course, if the stock stagnates, that 39 cents would give us a percent if unchanged of about 0.7%. But since it's a little bit, it's about $2 out of the money and the stock's been declining recently, it does have a low probability of being assigned on the call. A 38.6% chance of being assigned on the call, theoretical probability there. So, of course, I can increase that if I only want to see the positions that, now, with a standard caller, to get the returns I'm kind of looking for, I have to be right at the money or slightly out of the money with a short call, which means I can't look for a probability of being assigned of 70 or 80%, because that only exists on the calls that are deep in the money. The spreads that we're looking for here, the return that we're looking for and the risk we're looking for, won't allow a call option to be in the money because they won't have those numbers. So I can't look for a really high probability. But if I wanted to filter out some of those 35% probabilities on the call, or the, let's say, 40s. Let's say I just wanted to look for anything that had a probability of 40, let's try it, 45% or more. Theoretical probability that we'd be assigned on the call and earn the percentage return if assigned. See that changes it. We had about 383 results, standard callers, and now we're down to 87. Okay. Notice that some of those ones that were close to that 1-to-1 ratio are now gone, because they were further out of the money, and the profit that was getting us closer to that higher percentage return if assigned was based on the appreciation, not the premium. It was based on the stock moving up further. But by changing the probability, you notice that all the calls we're looking at, or most of the calls we're looking at, are now really close at the money. Skyworks at 27.55, here's the May 28 call. And AEM at 66.64, looking at the 67.5 call. And these are still good values. Potential to make 3.2%, guaranteed to risk no more than 4.4% for 44 days, 43 days of trading. That's not bad. That's not bad at all. Here's one 3.6% higher return. When you look for that higher return there, you also increase the percentage at risk. Okay, so it's always a trade-off in those fashions. All right. Okay, well, it's about 5:45. If anyone has any last-minute questions, I'm going to encourage you to go ahead and send those in. I'm going to navigate back over the slideshow here now just to wrap up a little bit. Well, we discussed this earlier on with Jack's question. 20-minute delayed, of course, gives you access to all the tools and all 23 different strategies with 20-minute delayed quotes, $60 per month. The real-time service, about $20 more or $19.95 more, technically. You still have access to all of the tools. You're not missing anything with a 20-minute delay. The only thing you're missing is the real-time quotes. And the historical data, of course, is not included on the 20-minute delay to real-time. The professional level of service includes everything that you have on the real-time service with unlimited access to the historical tools. All right, upcoming webinar events every Tuesday and Thursday at 12 noon Eastern Time. Kurt Frankenberg hosts his Introduction to Radioactive Trading presentation. And, of course, every Friday at 4:30. I wanted you to join me. Feel free to join me where we host the open discussion presentation. You can view archived presentations at any time. Simply go to powerup.com/webinars.asp. Sorry, that's not coming up too great with the background contrast color. Or you can access from the Learning Center menu. If you log onto your trial account, your PowerOptions trial account or your subscription, from the main Home tab, navigate over to the, navigate from the Learning Center menu to the Webinars page, and you'll be able to access those at any time. Okay, and if you have any other questions, okay, last call, send them over real quick. If you have any last-minute questions for the presentation, send them over through the question pod. If not, if you think of something later, just send us an email to support@powerup.com, or you can call us toll-free during market hours at 877-992-7971, or you can reach us internationally. If you live outside the continental U.S., you can reach us at 302-992-7971 during market hours, and of course there's contact links on every page. Okay. Jack, all right, got to run. You got to go eat. Your wife says she might throw out your food if you don't get off the computer and go eat. All right, well, go eat, Jack, and go enjoy your weekend, and we will see you hopefully next week for one of our free presentations. Ladies and gentlemen, thank you for joining me tonight. I hope you all have a fantastic weekend, and then we get to see you next week for one of our other live presentations, either the open discussion presentation Friday at 4:30 or the Tuesday or Thursday presentation with Kurt at 12 noon Eastern Time. Take care, everyone. Happy trading. Have a good weekend and a good expiration week next week. And hey, as you get closer to expiration, if you have any questions about your positions, remember I cannot give you direct advice, but we can discuss the math next week and go through as we get closer to expiration on your positions. So you just give us a call, send us an email, and let us know. We'll see what we can do. Take care, everyone. Good night.